Well, why aren't floating mortgage interest rates coming down? The Reserve Bank has hit out at commercial banks over their variable rates. A central bank report says the pricing of floating mortgages appears unusually high, and it believes there is scope for further reductions. The Reserve Bank says floating rates are 50 to 75 basis points higher than is justified. That is 0.5 to 0.75% on your mortgage. The Prime Minister John Key has told the Reserve Bank to come up with some solutions to bring rates down. But interest rates analyst Bernard Hickey of the website interest.co.nz says there's little the Reserve Bank can do without a law change. And he says the problem lies in the market. Bernard Hickey joins us now from our Auckland studio. Great to have you with us.
Good morning.
So what is the cause of the problem then? You're saying the Reserve Bank itself can't do anything?
It can't do too much without resorting to the sort of Muldoonist regulation of interest rates that we saw decades ago and that Alan Bollard himself says he doesn't want to resort to. What we have in the market right now is a sometimes unusual situation where one of the banks who was the main competitive driver, and that's Kiwibank, is not driving interest rates lower at the moment, because essentially it's run out of spare capital to keep lending aggressively. You've got to remember back to July or August last year when the Reserve Bank started cutting the official cash rate, and interest rates, particularly the floating rate, did drop in line with the OCR for most of that time, in large part because Kiwibank was setting the agenda and it pushed interest rates lower, often announcing just minutes after each official cash rate that it was pushing down its floating rate as well as its fixed rates. And so the main banks were forced to follow. And what actually happened through that August to December period was that Kiwibank led the market. And since December, it has taken its foot off the accelerator because it essentially doesn't have extra capital that it needs to keep lending so aggressively. Kiwibank took 2/3 of new mortgage market share in between July and December. And that's because it was pushing hard when the banks weren't. Now that Kiwibank is not pushing hard, the banks aren't following. And one way that the government could put some pressure on the banks without changing the law and resorting to Muldoonist sort of tactics is to pump extra capital into Kiwibank so it can start competing again.
What extra capital?
Well, it needs probably a couple of $100 million to give the banks a good go for another year or so. And to do that, the government would simply have to inject more equity, cash, if you like, into the balance sheet of Kiwibank.
What I was saying is there any money around in the current environment? But you're saying $200 million it should be able to find.
Well, the government could come up with that money. It's certainly spending that much in other areas. The question is it worth it? Because when you dig through the Reserve Bank's numbers that came out yesterday, it's clear that the Reserve Bank is saying that floating rates are a little bit too high, but fixed rates are about right. Now remember, most New Zealanders, about 80%, currently use fixed rate mortgages. So the Reserve Bank is saying those people are not being ripped off, if you like. It's just those people on floating rates. Now,
well, you can say it's just those people on floating rates, really, because they are the rates that should be responding to interest rate cuts. They are the rates, that can move and move quickly. And 0.5 to 0.75% is a hell of a lot on an individual's mortgage.
It is a lot, but only about 22% of New Zealanders use those floating rates. The question is, how much is it worth? Now, my calculations using the Reserve Bank's analysis are that the banks are overcharging, if you like, by around about $200 to $300 million a year at the current rates. But the Reserve Bank's own analysis shows that the banks are undercharging by around about the same amount on fixed rates. So what's happening really is that the banks are subsidising cheaper fixed rate mortgages with relatively high floating rate mortgages. So the consumer can exercise a choice here by saying, okay, I'm being overcharged on my floating rates. Maybe I should just move to a fixed rate where I'm getting a better deal. And they are cheaper out sort of 1 year, 2 year rates at the moment.
Why was Kiwibank, the smallest of the big banks, leading the charge? Why weren't the others competing?
Well, it was leading the charge, and the other banks were sort of dragged into line into competing. Kiwibank saw an opportunity. Kiwibank had a large volume of relatively cheap funding from mums and dads putting their money into term deposit accounts. The other problem for Kiwibank now, though, is that it's having to compete much harder for those term deposits with the bank. So even though we're not seeing the red-hot competition in mortgages, we are seeing red-hot competition in term deposits. And just yesterday, Kiwibank had to put up its one-year term deposit rate to 4.6% because of that competition. So what you've actually seen, and this is the thing, one of the arguments the banks make, is that over the particularly last 6 months, they've had to compete